Today, I'm going to share with you how to structure a seller finance offer. I'm going to cut through the fluff so you can quickly learn how to structure these offers and make it a win-win solution for everyone. Hey, my name is Chris Goff and welcome. This channel is all about helping you grow your knowledge base, increase your confidence, so you can put more money in your pocket as a real estate investor, no matter if you're just starting out. I always say, if the seller picks the price, you pick the terms. If the seller picks the terms, you pick the price. And if the seller picks the price and the terms, they're not motivated. Follow up in 30 days because people's circumstances change in time. Seller financing is what we call a term strategy, meaning how much down, how much a month, and how long can we do it for. This is the opposite of a wholesale deal where you need to pay the seller in one lump sum. Just think about it. Almost every major purchase made by most people use terms because they don't have enough cash in their bank account to buy houses, cars, boats, RVs, cell phones, and so much more. All right, let's review what makes up a seller finance offer. The very first thing is what we call the sales or purchase price. What are we going to be buying the property for? Next is a down payment. Next is an interest rate. That is going to determine the monthly payment. Taxes and insurance, because keep in mind, you're going to be owning the property. Length of loan, meaning how many years are we going to amortize this loan out for? Now, most loans are generally either 10, 15, 20, or 30-year loans. Now, the loan term is what we talk about with the seller. Now, if we amortize the payment, the loan out for 30 years, a lot of sellers aren't going to want to wait 30 years to get their money. So we'll do what's called a loan term. Things to also consider: repairs, holding cost, attorney costs for even drafting up the contract, and closing cost, any HOA dues. What is your exit strategy? Now, this is just for example purposes, but now we're going to fill in each one so you can see exactly what the offer looks like. And remember, this would be an example offer to the seller. So we set a sales price here at $350, a down payment of 10 grand, interest rate set at 4%, which gives us a monthly payment of $1623.21. Taxes and insurance per month would be $195.83. The length of the loan, we're going to amortize this over 30 years, but the term with the seller is what we call a 5-year balloon. So you could go 3 years, 5 years, 7 years. You could change this number up depending on how long the seller is willing to do this for. But what this means is we're going to make payments based on an amortization schedule of 30 years, but we must pay the seller off within this 5-year term. So whatever the balance owed, you can also buy it prior to the 5 years. You would need to cash them out. That gives us a total monthly payment of $1819.04, which would be your monthly payment, which would be your principal interest payment plus taxes and insurance every single month. Now we need to determine the sales price. Now this may be one of the most important steps because you need to understand, what is this property even worth? So the best way to do that is to run comparable sales. Now, running comparable sales, we can determine the after repaired value, also known as ARV. This would be the maximum value of the property in tip-top shape. If you're an REI Pro member, you already know this. That's also going to give you access to all sold properties, not just on the MLS, but also any kind of for sale by owner properties as well. So it's going to give you the best of both worlds. When running comparable sales, you are finding properties that are similar and that have sold, not the homes listed for sale, homes that have sold. You're also looking for similar square footage, bedrooms, bathrooms, age, condition, and location. Now with REI Pro, you can access MLS comps in all 50 states. Now let's determine the down payment. Now, as a rule of thumb, when negotiating with sellers, negotiate the down payment as low as you can because, that's cash out of your pocket that could be used to repair the home. So typically the down payment could be anywhere from 0 to 10% of the sales price. Now you could go higher in certain circumstances. Really just depends on how the numbers, play out, what kind of purchase price you can get. If you could get a better purchase price, you might, put more money down. If you don't get a great purchase price, you might want to consider putting less down. So I think you could go back and forth like a seesaw here just to balance out what do you need to do from a financial standpoint and what does the seller want, or what are they willing to take. Let me give you just a couple of no money down techniques. The first one is what we call a double down payment. So since every home will need some type of repairs, you could tell the owner that you don't want to give them money down and then have to turn around and put money in the home for repairs. Now the seller, could agree with you or not agree with you, and they could say, Chris, I don't really care about that. I want money down. Well, maybe you move to, another strategy where maybe you raise the sales price and try to get in with no money down. Could also provide a testimonial. Using testimonials on previous deals is going to show the owner that you're credible and that you've been doing this. A big part of testimonials is the simple fact that, do they trust you? And if they trust you, they're more likely to do the deal with you. You could also offer 3 payments up front, right? So maybe I could get in with no money down, but I'll give you the first 3 months payments up front. Now, eventually, whatever exit strategy you do decide, obviously you could get that money back. So you're really not spending money out of your pocket. You'll be able to recuperate that money. So just a few different ways to get in with no money down. I'm here to tell you most sellers are going to want something down. The extremely motivated seller would accept a no money down deal because of the situation that they're in. There are some people that, hey, please just cover my monthly payment right now. That's all I want. That's their burden. So most people will probably want something down. Again, keep in mind, you need to keep this as low as you can. Now we need to determine the interest rate. So once you've determined the sales price and the down payment, we need to figure this out. Now there's 2 numbers are going to determine the monthly payment. So once we get that purchase price or that sales price, and now we've established that interest rate, we're going to put that in a mortgage calculator. It's actually going to give us our monthly payment. Now, from an interest rate point of view, I like to go anywhere between 2 and 8%. Again, this will be very dependent on the deal and what the seller's willing to take, and some other factors too of, your exit strategy where, if you're buying at this price and the interest rate is this, that monthly payment may be too high for you, or you may have to adjust some of these numbers just to make it work for your exit strategy as maybe you're renting the house. So now we'll determine the monthly payment, what we call P&I, so principal and interest. So now we have the sales price, we have the down payment. Remember that down payment is going to be subtracted from that sales price. Now we have an interest rate. We're going to use that mortgage calculator, and that's going to calculate your monthly payment. So let's determine those taxes and insurance. Now you can simply look up the property on your local tax assessor. You can obviously use REI Pro. We're going to give you that tax value. What does it cost in taxes for this house? Now, that number is different across the country. All counties have different formulas on how they actually calculate taxes. Then you can get an insurance quote. There are tons of companies out there. Now we need to determine the length of loan and terms, right? So the length of loan, we typically go out 30 years because we want this monthly payment to be as low as possible. Now, you could go 20 years, you could go 15 years, but just keep in mind that's going to increase that monthly payment. So generally, we will go 30 years. Now, loan terms with the seller is what we call balloon payment. Now, like I said before, most sellers are not going to wait 30 years to get their money. They want their money much sooner. We typically go 5, 10 years. And again, this could change depending on the seller. Seller may say, hey, Chris, I don't want to go past 3 years. I don't want to go past 6 months. Some sellers say, hey, I'll go 20 years. So it will vary. And I think what we need to look at is a good 5-year term, because I think that 5-year term is where you really start to build equity in the property. So if you're a buy and hold person, that 5-year number is really pretty good. All right, so let's actually structure this offer. So one of the most important things, we need to figure out what that after repaired value is. We did that by running comparable sales on this particular property. Again, this is just an example because I want you to understand it. $395. We also have repairs. So we visited the property and determined that $25,000 would be needed to fix up the home. You're going to have some holding costs during this time that you're remodeling it. Of course, you're going to have paperwork. Every seller finance agreement, I highly recommend having a real estate attorney draft up the paperwork. Now, this cost could vary depending on where you live in the country. There'll be closing costs, right? So we're going to actually close this deal with the seller. That's going to be closing cost on our side. Again, this is going to vary depending on where you live in the country as well. Also want you to throw in payments for 3 months. In this particular example, I'm just guesstimating the time frame it would take to repair the house before I decide what my exit strategy, if I'm going to rent it, lease option it, sell or finance it, or just sell it. So I want to make sure that I throw this in because those are payments that we're going to have to come out of our pocket, paid to the seller each month. And then exit strategy cost, again, I just put 0 because there's so many different directions you could go here. Like I said, you could rent it, lease option it, sell or finance it back out, or simply sell it. So your price after these expenses, and you could always throw in some more expenses here, but these are going to be the big ones, drops our price really down to $360,000. So if these expenses were true and I bought it for $360,000 from the owner on a seller finance, I pretty much paid full price for the property. Do people do that? Yes, because they want to use it for a long-term hold. And the great thing is they didn't have to go to the bank because it's seller financing. The property's not going to go on their credit report because it's seller financing. So there are some benefits that may outweigh, the fact that you're purchasing it at full price. Here's what my offer would be. Remember that number, 360, that's going to be that price after expenses. I want to start my offer obviously less than that, and it could even go lower. Now, I would recommend just don't even it out. Like in this example, $350,000. You might want to do $350,470. You want to make it look strange, like you must have calculated this number. You put a lot of thought into it. Okay, you just don't want to throw out an even number. In this example, I think $10,000 down. Keep in mind, I'm still going to need some cash to fix up the home, actually purchase the home, and so on. So $10,000 I would offer to the seller. Now, if they came to me and said, hey, I'll take, $5,000 down, then I wouldn't offer the 10, right? But what happens if the seller comes back and says, no, I need $50,000 down? I'm still going to offer the 10 because financially it may not work for me. And again, I would need to run those numbers with a different down payment. Set the interest rate at 4%. I want to go as low as I can. I think if you go too low, it doesn't make sense. If you go too high, it may not make sense for you, right? Because that's going to change your monthly payment, which could affect your exit strategy. Monthly payment comes out to $1,623.21. Taxes and insurance. Now, this was just a tax, on this particular property plus an estimated insurance amount. I just combined the two together. Comes out to $195.83 a month. Again, be sure to calculate that for your property. We're going to amortize this over 30 years, but we're going to do a 5-year balloon on this. So I'm going to keep making payments on this property for up to 5 years. Now, keep in mind, I still own it. The deed's in my name. I just have the owners, the lien holders, like they're the bank. So I could cash them out tomorrow, but I have up to 5 years to do that. Total monthly payment, which is principal, interest, taxes, and insurance, is going to be $1,819.04. Now let's look at 5 years later because we're going to have a balance that's owed to the seller. Now, if you can see here at month 60, we're going to owe all the way to the right-hand side $307,000. Now, there's two ways to pay the seller off. You can either sell the home or you can refinance the home because that is the end of our term with the seller. Let's look at a 5-year breakdown for the seller. Like, why would they do this deal? Well, number one, our balance is that 307. Total monthly payments, keep that in mind, it's at $1,623. Now, if I multiplied that by the entire 60 months, 5 years, they would receive $97,000 in just monthly payments. So total paid to the seller in this example is almost $415,000. Keep in mind, we bought it for $350. But after 5 years, because of interest they have earned on the property, they're actually making more money. So that difference is about $65,000. I want you to remember, they don't have the tenants, the turnover, the repairs. Remember, they don't own it anymore. They're just the bank. We take on all that responsibility. So their profit margin is going to be at its highest here because they won't have any additional expenses in the property. And it's a great way to look at from a seller point of view that this is an investment and they're making money on their investment. They're just getting a check from me every single month until I cash them out. They don't have to worry about anything else because now, remember, I own the home. You always want to make this a win-win, right? So there are thousands of ways to structure these deals. So you need to determine where the motivation is with the seller, and you'll find out, is it the sales price? Do they want a higher sales price? Or is it more about, I want more money down? So I think you're going to figure out where that motivation is just by simply talking to them. You could create numerous types of offers. I might increase the interest rate. I might decrease the term. There's a lot of different ways that you can structure this. And I think it's really coming down, is it a win-win? Does it make sense for both parties? So your goal as a real estate investor is to structure the numbers to make it a win-win for all parties involved. Let me give you some key takeaways. Number one, if the seller has an existing mortgage, you're going to need to do a wraparound agreement so that's subject to existing financing because there's already financing in place. Now, that won't change the way that we structured the offer, but it is something to note. Obviously, you're going to need a mortgage calculator because you're going to need to figure out your payments. You're going to need to amortize this. You may have to adjust the sales price and the interest rate to arrive at the best monthly payment that works with your exit strategy. Just think about it. If you're going to rent the property out and our total payment is $1,900 to the seller and the property only rents for $1,500, well, that's not going to work because that would be negative cash flow. So you may have to adjust some of these numbers to get that monthly payment where it meets your exit strategy. Now, be sure to receive this IRS Form 1098 from the seller because it's going to report the interest on the property. Now, this deduction provides up to 100% of the interest you pay on your mortgage is deductible from your gross income, along with other deductions which may be eligible for a tax liability is calculated. So be sure to speak with your CPA on this. Now, let me show you a different property and calculate it inside of REI Pro, and you'll see how easy this is. So as we go up to step one, again, we have our after repaired value. This was calculated with our comparable sales tool and carried over. Now, the first thing that we want to do is to be able to set the price that we're actually going to pay the seller. Now, generally, I can keep this price less than a lease option offer price because I know that the seller is going to receive interest from me, which ultimately is going to make more money by doing it this way. So in this example, I'm going to put $250,000. Now, although the property is worth $307,000, obviously there could be some maintenance costs, repair items, just getting the house in tip-top shape and so forth, just to get somebody else in this property. It's irrelevant if the owner has a current mortgage on the property, you could still sell or finance it. If they do have a mortgage on the property, it could adjust your number depending on where their payments are, where their loan balance is. So obviously, we would like to get that information, but keep in mind, you still have to craft an offer that makes sense for you, regardless of what the seller has going on over here. Next is the down payment. Again, this will be credited to the purchase price. Now, generally, the down payment is going to be higher than a lease option down payment. But of course, you as the buyer, you want to go in as low as possible because the sellers want as much as possible. In this example, I'm going to put $10,000. Next, we have to determine what the interest rate is. So the purchase price minus the down payment, then amortized with the interest rate is going to determine what the monthly payment is, or what that principal interest payment's going to be. Now, again, I want to start as low as I can, right? Where the seller may need a higher interest, but always start somewhere because you can always come back and adjust these numbers. I'm going to enter 5% as an example. So the next one is loan amortization. So what is the length of time used to calculate this monthly payment? Now, traditional mortgage, when you go to the bank, it's generally 30 years. And that's going to keep that monthly payment down as low as possible. And of course, that's what we would want. So I'm going to put in the number of years as 30. Next is our loan term in balloons because a lot of sellers, they may not want to wait 30 years to receive all their money. So as an example, although we're amortizing the loan for 30 years, the seller may only give us 5 years to cash them out. So what happens is if I put in 5-year term here, my loan's being amortized over 30, but before 5 years is up, if we go all 60 months here, 5 years, whatever the balance owed on the property, I would need to pay the seller in full. Generally, what people do is this is where they would refinance the property to pay the original owner off and create a new loan on that. A lot of times you could actually refinance it for a little bit more than what you owe the seller, which would be a lot of tax-free money coming your way. Next is if you're going to apply any additional principal payments, also the property taxes. So you can find this in step 1. So the property taxes for this property is $3,500. Now we're going to put in the insurance, which I know is $1,200. Now, if there's monthly HOA dues, you would obviously need to enter that there. In this particular case, there isn't. So now when I go up to the summary, it's going to really break down everything. So we have the after repaired value. We have the sales price, what we're going to pay the seller, $10,000 down, 5% interest. We're going to amortize the loan over 30 years to keep that monthly payment down. You're going to do the term of the loan, which we call balloon payment, for 5 years. Our monthly principal interest payment is going to be $1,288.37. So the total loan payment is going to be $1,288.37. Now keep in mind, you also have taxes, insurance, depending on, how this is going to be paid. Sometimes it's paid within the loan that's originally already in place if the seller has one, and sometimes it's not, and that could be paid separately. At the end of the day, you really need to look at the total monthly expense because you own the property now, so you have to pay the mortgage, you have to pay the principal interest payment plus the taxes and insurance. So that brings it up to $1,680. Now the loan balance after 5 years is going to be $220. Total principal payments for 5 years is $19,000. Total interest paid is for 5 years is almost $58,000. So I want you to keep in mind and just think about it this way. Let's assume for a second the seller has no loan on it. Okay, so they're just making all this money. So they've made almost an additional $58,000 just in interest. That's why it's one of the most profitable real estate strategies there is. So as you can see, total paid to the seller over the course of 5 years was $307, which is funny. It's right where it's worth, even though we paid $250. Now you can always see the payment breakdown by clicking the amortization schedule right here, all the way how much principal, how much interest every single month, all broken down for you. Now, once I save this, I can now view, print, or I can email this particular offer. Obviously, any kind of offer that you have, you always want to put it on paper, but you want to talk to the person as well. Either be in person or over the phone. You need to explain a lot of pieces to this. So get out there, start making seller finance offers, and I hope this training video helped and look forward to seeing you on the next one. I put together a video that will teach you how to get tax-free money to purchase more deals using the seller finance strategy. You can see that video right here on your screen, and be sure to subscribe now so you can receive more videos about investing in real estate the correct way. And I'll see you on the next training video.